there is evidence the economy is pretty soft, whether you're looking at housing sales or autos or durable goods.
In times like these, I think it's time we get back to the basics. It's time we get back to the fundamentals and to unburden ourselves of the way of the bear, to repent and wash our sins clean of the violence, the shorting, the suffering, and the fuckery, and to think back to happier times. So if we could all please turn to chapter 14 of the holy book, The Intelligent Investor, let's read together. The intelligent investor is a realist who sells to optimists and buys from pessimists. And remember, WWBD, what would Buffett do in times like these? Buffett would buy the dip. Oh, wait. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and just a ton of red everywhere. Small pockets of green in certain stocks, not even in the sectors. Stuff like CrowdStrike, AMD, some semiconductor equipment manufacturers. That was the sum of it. Stocks completely red everywhere else in technology, financials, communication services, healthcare, even the defensive stocks that outperformed last week, stuff like utilities, real estate, consumer staples, they were heavily in the red. And this was just a complete liquidation, driven in part by some of the fears we saw last week with regards to the economy. There was also a bunch of geopolitical concerns, certain things going on in Europe that I think added to this. And in part, we saw healthcare, utilities, financials all down 2.5% and greater. Technology being the worst performing sector, down 3.3%. Industrials were the best performer, up 1.7%. But the market really getting jittery in the face of all of this. And even small caps, mid caps were sold off too. Mid-caps, the best performing size segment between the three large sizes, including megas. If you want mega caps here, they outperformed the mega caps, and nothing was safe today. There wasn't safety in value, core, or growth. Everything took it on the chin. If you were just in stocks today, it wasn't a good day for you at all. There were a couple of things that we need to talk about. So the Nasdaq 100, S&P 500, and IWM all finished about 2.89, 2.92, 3.24% respectively. But at one point, some of these stocks were down 5%. So we saw quite the recovery off the open into the high of the day, which coincided with TLT bottoming out. So what we actually saw was traders actually selling bonds, yields rising as a result. Stocks actually rose in the face of that. And then when they started buying bonds again, yields fell, stocks actually fell as a result. And that's why today's trade probably feels more on the geopolitical tension than it does the actual macro concerns, because we actually saw bonds, TLT, in negative territory. If the market was really concerned about growth, we would have seen a more panicked flight into bonds and the dollar bid up. That simply was not the case. We saw people selling bonds and the dollar actually selling off as well. Now, in part, that has to do with the reverse carry trade we are seeing with the yen. There's a lot of things going on with the dollar, but based on economic theory that I know, what we are seeing is in part due to the macro, yes, but not entirely the macro. What we're seeing is just uncertainty concerns leading up into the election, with what we're seeing some of the stuff in Europe, with what we're seeing in the Middle East, and with Japan. That's why bonds actually sold off into the day, and then they sort of caught a bid right here, and then stocks continued to move lower. But some constructive price action off the open right here, but I don't think the selling is done. In the S&P 500, we are in a very clear downtrend. There's no two ways about it. We are in a daily downtrend. The trend is down, and we're slicing through key levels. We sliced through the gamma flip. It all moved lower along with the core resistance and the put support, which is now at 5,100. And guys, on a technical basis, the next key level of support before things get very, very ugly is this 4950 area right here. Now, I do think that we're probably going to see a pretty big bottom here at the 5100 area. We're at 100 points from there, but if we do break below and move lower, then things are going to get really ugly for the market. But we are seeing a bit of a bid here. We saw a bid up in today's trade. We are also seeing stuff like the IWM, the RSP, fairly green here in extended hours. This in part driven by some of the earnings reports we got from stuff like Palantir. We're going to talk about it in the earnings segment of the video. Today's trade was very brutal. The S&P 500 down 3%, Nasdaq roughly down the same, the IWM down 3.22%, RSP down nearly 2.5%, mid-caps lost 2.71%. Long duration yields gapped down but came strongly off their lows. AGG was actually flat on the day, down ever so slightly, significantly down from its highs right here. TLT gained 0.53%, and then you had commodities not really acting like a hedge. Gold saw some very volatile price action, down 1.35%, but look at this candle. That is gold. That is absolutely nuts. This is some of the craziest volatility we've seen in gold in the last couple of months. And then silver down 4.59%. And guys, when you have geopolitical concerns coupled with global growth concerns, I think at that point, there's not going to be a hedge. It's not going to be gold. It's not going to be silver. It's probably going to be like bonds and going to the dollar. That's going to be your hedge. It's literally a liquidation. And that's what we really saw today, exacerbated by all the factors we saw last week. So where does it leave us with the S&P 500? It leaves us in a pretty dangerous place right now. I mean, the S&P 500 approaching not just key levels on the gamma chart, but technically speaking, if you go into the weekly chart, we are very quickly approaching some of the absolutely key levels that we saw here at the start of 2024. And really below these levels, there's not a lot of support. And this is where things can get very dangerous for markets. However, we do have to get there first. I think 5,100 and 5,000 are going to be very, very strong levels for the bears to break through, but we'll take it one day at a time. And if we actually go on the daily chart right now, that one day at a time means we actually look at the 5,100 area as our first main area of support. If we then go ahead and break this, we're then going to actually just look at the lows right here, 49.50, maybe 49.60. We'll have to see what tomorrow brings. Looking a little bit upbeat here in the after hours. Looks more like a dead cat bounce. I think maybe just sellers, short sellers, just taking profits, not wanting to hold anything overnight, especially with the geopolitical uncertainty we're getting. I mean, at any point, anything can go down. So we're just seeing a little bit of short covering, particularly in the higher beta names. We can also see that the S&P 500 though is up 0.57, 0.52%. But guys, we're in a clear downtrend. We don't want to fight the trend. I think it's best that if you really do want to trade this market, sell rips. Sell rips until we actually get into the 5,300 area. That's when we could maybe start looking at building a support base for us to move back and take some of these higher levels. But until then, we don't want to fight the trend. We just want to sit through the volatility, and we want to buy stocks we really like. I actually did buy some more PayPal. I think this is looking mightily attractive. I actually did buy some more Google. Guys, this thing is trading on a 17 times PE forward. 17 times forward. That's cheaper than the S&P 500 multiple right now. Paycom Holdings is definitely something I'm going to start loading up on, particularly Google. Google looks super attractive. I think Google is a great buy right now. So that's what I'm looking at. But if we just dive into the Nasdaq 100, look at all of these stocks on a peak to trough basis. We can see peak to trough down 15%, peak to close 13.53%. That is super attractive. Looking at the S&P 500, let's use the US 500 on a peak to trough basis. We could see down 10.21%, officially in corrective territory. But if we actually just take it to the close, down 8%. So not quite 10% correction. We did wick there, but not quite. Looking at the IWM, we're back in this balance zone right here. What is the IWM doing right now on a year-to-date basis? If we actually go year-to-date, yeah, up about 1.4%. In fact, cash has actually beaten the return of the IWM. Cash has actually returned about 2.2% so far this year. But for all intents and purposes, guys, we are in a downtrend. You don't want to fight the trend. You just want to look at key levels, see how we react, and then make a decision after that. So don't predict what's going to happen, just react. Right now, especially with the S&P 500 down, wicked down 10% from its highs, I'm a buyer. I did buy stocks today in the US market. I'll continue to buy some ETFs in the Australian market at the open in 2021, 2022, when stocks started selling. Sort of when the S&P 500 got to that 10% drawdown, that's when I really started heavily buying Meta. So I'm buying stocks right now very heavily, and we'll continue to buy if we do go down. I do think at the end of the day, this will probably just be a growth scare, but I do think that we probably are going to continue trending down unless we break the 5,300 for the rest of the week. It's quite simple. We don't have a lot of economic data this week, and the trend is down. That means we're probably just going to follow the trend. Yeah, we could bounce a little bit here. The after hours, you know, the IWM already up a full percentage point since I started recording this segment. But for all intents and purposes, you know, on the daily chart, the trend is down, and you don't really want to fight that until we retake the 5,300 area. So with everything going on in the market, I think it's time we talk about sentiment, specifically what sentiment is looking like in our community. 879 of you voted in this week's weekend poll, and I kind of made it vague this week. I said, for the S&P 500, are you bullish, bearish, or neutral? No real time frame, because I just wanted to gauge overall sentiment, and this is pretty bearish sentiment. 48% of you bearish, 16% of you are neutral, 36% of you are bullish. A lot more of you are bullish than what I initially thought, especially after some of the price action we saw last week. 48% of you guys voted bearish. That's very bearish sentiment, and I can't wait to see what the AA sentiment survey has in store for us. And I got some amazing stats right here. The 30 best matches in the last 30 years after a similar VIX spike that we saw on Friday. Volatility has moved up in a very big way, and this is essentially a large VIX spike, the S&P 500 return on the day, and then forward returns for the S&P 500 1 day, 5 days, 1 month, 3 months, 6 months, 12 months later after a huge spike in the VIX. On Friday, on the 2nd, we actually had a VIX spike of 25%. Volatility made its way all the way up to 23, but as high as 30. The S&P 500 fell 1.84%, and this is 30 best matches in the last 30 years to the day we saw in the S&P 500. And you can see that average returns tend to be fairly lackluster in the week after. You can actually see negative 0.034% 1 day later, negative 0.19% 5 days later, and even up to 1 month later, we can see the S&P 500 trade pretty much flat, slightly positive, up 0.37%, and the hit rates tend to be very poor. And the thing here is 12 months later, the returns don't look that stellar. Average return 3.95%, median return 5.22%, 20 wins, 10 losses. So again, a very ugly hit rate. But what's crazy is actually the max drawdown. In every single one of these instances, the max drawdown was 10, 17, 18%, 15%, pretty much in the high teens. Meaning, had you actually bought the dip, waited 12 months later, including the drawdown, had you bought the dip plus the 3.95% return you would have got on top of that, the S&P 500 tends to do very well. So as bulls in this type of environment, you want to get excited because we get outsized returns in the next 6 and 12 months. Even if the stats don't show it from the lows, the returns tend to be quite stellar. And that's when you really get your outsized returns in stock. So guys, have a dollar cost average plan, buy the dip in a very big way, because at the end of the day, this is all short-term noise, especially looking 1 year, 12 months down the track. And also you have to understand we are in a seasonally weak period of the year. August tends to have flat to negative returns, and with the 10-year yield at its current rate of 3.8%, we often see the worst performance returns for stocks. When the 10-year treasury yield is between 3 and 4%, we often see annualized returns in the S&P 500 of 5.4, 5.6%. We are in a very volatile environment right now. History tells us seasonally that we can see near-term volatility in the next 3, maybe as far as 6 months, but you do just want to buy the dip, because at the end of the day, stocks always go higher. Think about the bearish sentiment we saw in 2022. Had you bought that dip, you're thanking yourself. And at the end of the day, you have to bring it back to earnings. S&P 500 earnings are still looking robust. This is the latest earnings growth by JP Morgan. They see 2024 earnings at 244. That's 11% growth, and then 279 in 2025. Until we actually get major earnings revisions, that's when the fundamental picture changes right now. But Q3 earnings look very solid. So far, we actually haven't seen any material revisions to earnings. And if earnings over the next 12 months are going to stay robust, they're going to stay where they are, stocks will do well, especially with margins improving up to the 12% mark in the second quarter 2024. And with valuation, that leaves the S&P 500 right now at 20.9 times. So still a bit elevated. I think about 20 is probably fair value. I think anything below 20, great buying opportunity. But if you want even further value, you can actually look at stuff like comm services and healthcare. You know, both of them trading at 1.1, 1 PEG, free cash flow yield of 4.8% here for comm services, trading on a forward PE of 18.2. Very attractive. Comm services and healthcare. I still think the least attractive sector is information technology on a PE basis, but if you actually look at it on a PEG basis, the growth on a price to growth basis is far superior to these others. But if you really want the best risk adjusted returns, look at stocks in the healthcare and comm services space. Looking at earnings this week, the bulk of earnings season is behind us, with almost 50% of companies having reported in the last 2 weeks, but we still have a pretty big week. 8% of S&P 500 companies are reporting this week. That's still a pretty big week, all things considered. There was a number of companies that reported. Berkshire Hathaway here reported before the open. The Carlyle Group, Crystal, Freshpet, Tyson, they all reported earnings right here. Today, after the bell, we had Palantir and Hims. I looked at these two earnings very briefly. Hims and Her Health actually reported a double beat, raised guidance above the consensus expectations, but they were down like 12% in the after hours. So maybe there's something that the market's not liking, competitive concerns, margin issues, something in the earnings right here the street's not liking, and that's why it got sold off. Because when I just looked at the headline figures, things looked really good, but that's what the headline figures are there for, to make things look really good. Palantir was up 16% or so in the after hours. Fantastic earnings. In fact, the street was expecting 22% growth for this quarter here in Palantir. They actually produced 27%, absolutely smashing growth expectations. So that's why they were up 16%. Great, fantastic earnings from Palantir. I think we even saw margin improvements across the board. Great stuff. And then tomorrow we also have a couple big names. Uber before the open, Celsius, Fubo TV, Caterpillar. Those are some very big consumer stocks and an industrial stock. And then after the close, we have Supermicro, Rivian, Airbnb, Wynn, Reddit, GigaCloud, Upstart. A very big day tomorrow, especially in the software space. And while there's many factors impacting stocks and the market as a whole, it all really started last week when it came down to the NFP print. We got 114k in payrolls. We were expecting 175k. A huge miss. Now, there's been news circulating that part of it actually had to do with Hurricane Beryl and the weather. The BLS dismissed it. However, we do have some very interesting data. Workers with a job but not at work due to bad weather, and then unemployed workers on a temporary layoff. We saw huge spikes here in the most recent print in both of these, suggesting that while the BLS said Hurricane Beryl had no discernible effect, the number of workers not at work because of weather and the number of temporary layoffs both rose substantially. So it's definitely something that we do need to look at, and we're going to see what the revisions in the next non-farms look like for these specific numbers. Definitely something that we want to pay attention to. But Goldman continued to say our estimate of underlying trend job growth remains close to our estimate of the break-even rate, though any further decline would imply a steady rise in the unemployment rate. In other words, the US labor market is pretty much at a breaking point, and right now things are looking very shaky. And Goldman actually raised that 12-month recession probability by 10 percentage points to 25%, but they still see downside risks as limited because the economic data overall does not look weak and the Fed has plenty of room to cut. And that's just the thing. We are getting this bad data going into a cutting cycle. This is what the hiking cycle was supposed to do. Slow down growth enough to see inflation come down. And now that that's happening and we're seeing the real brunt force of it, it's time to cut those rates, stimulate the economy. And look at 2020. Use 2020 as your barometer. The second you cut rates, the market feels those effects immediately. And Goldman expect an initial string of consecutive 25 basis point rate cuts in September, November, and December versus quarterly cuts previously. But a 50 basis point cut in September would be likely if the August unemployment rate is weaker than expected. So they see right now 75 basis points worth of cuts into the end of the year, but potentially 50 basis points, which would result in a full 1% decrease in the Fed funds rate by December if the August employment report is weaker than expected. And all eyes are going to be on the August employment report. We pretty much know that disinflation is probably going to start to accelerate after this employment report, but everybody's going to be watching initial jobless claims this week, and that is probably the biggest data print we get this week. Initial jobless claims, the expectation is 240,000. Other than that, a fairly light week. We did get ISM services today, consumer credit, wholesale inventories, but the biggest point of contention is going to be these initial jobless claims as well as continuing claims, especially the week after non-farms. And this is just going to be more data for us with regards to the labor market. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.